Hey everyone, I am so excited to be here today. I have another video for you all about dividend stocks. I want to discuss Johnson & Johnson in the video today because they just increased their dividend by 6.6%. I'm deploying more money into Johnson & Johnson, and I want to explain the rationale behind my investments that I'm making right now in Johnson & Johnson. I also want to cover this overall market right now that is tanking. It's dropping quite a bit. Why is that? Well, the Federal Reserve is expected to increase the interest rate by 0.5 point. This is more than the forecasted 1/4 point increase that everyone was expecting. 0.5 point is pretty big, and it's the largest expected increase since the early 2000s. We haven't seen this since the early 2000s, and so this has placed pressure on my favorite stocks like Johnson & Johnson. They're going down. The whole stock market is going down because as interest rates go up, it's more expensive for companies to finance their debt, and investors also have alternative places they can place capital and earn yield. Nonetheless, it's really great to be a dividend stock investor, despite stocks going down. Despite making a lot of purchases earlier this week at higher prices, I'm excited that the stocks are going down because I can buy progressively more dividend yield on my money. The more dividend stocks go down, the higher the current starting yield. It's a win for me as a long-term dividend stock investor. And also, even though the stock prices are going down, companies like Johnson & Johnson are thriving. I'm going to talk about that in the video today. Companies like Otis Elevator Company are thriving as well. They just increased their dividend by 20.8% just today. Staggering. Anyway, I am so excited to be here. I can't wait to do the video today. Get ready, everyone, for a really exciting video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, so I have a lot of ground to cover today. One thing I want to share with all of you is check out the pinned comment below. I have a link there to my Patreon. I share all of my stock trades over on Patreon. I also share bonus content such as videos as well. I have 2 different tiers, so check those out. The reason I'm bringing this up is I just published an updated stock portfolio on Patreon. I have all of the percentage allocation to each position. That's on the corner patron tier. The reason I did that is I wanted a before because I'm going to be making a lot of changes to my portfolio going forward. We've sold our house in the Bay Area. We're in process of making a big move here for our family, and I'm using some of the capital that came out of the home sale to increase the dividend stock portfolio allocation. And in terms of rebalancing the portfolio in some ways, I don't sell stocks very rarely, but what I do is I use net new capital to place more emphasis on certain positions. And so I'm sharing all those trades over on Patreon, and on the corner tier level, I'm going to be sharing updated stock portfolios. Now that you've seen the baseline, let's see how this thing evolves over the coming 6 to 9 months, because there's going to be a lot of changes. And so thank you everyone for checking that out. And now without further ado, check it out on the screen right now. I want to share the first piece of news about Johnson & Johnson, and that's the fact that they increased the dividend by 6.6%. This was on April 19th, so this was earlier this week, and this was a big piece of news for investors. I think all of us were really excited to see that. It was a little bit bigger than the last increase, and all they have to do is just keep that up, and the dividend snowball over time can work miracles in terms of yield on cost. And so these days, quite frankly, as an overall portfolio strategy, I'm really focused on stocks like Johnson & Johnson, core stocks where the starting dividend yield, it doesn't have to be too huge, but it can grow over time. I don't need so much yield right now, but about 5, 10, 15 years from now, I'll have a lot more passive income coming in because I'm willing to wait for those dividend increases. So what I want to share are some statistics. Check it out in front of you right now. You can see an Excel spreadsheet that I put together for the video today, and this shares the statistics on Johnson & Johnson. And so as you can see in front of you right there, my last purchase on Johnson & Johnson was at $178.39. The earnings estimate going forward, analysts expect $10.33 this year, $10.96 next year. And so that places the forward PE at a 17 this year, 16 next year. I highlight that PE, especially in 2023, because it's a solid value PE in my humble opinion. Now, why is Johnson & Johnson trading at a lesser PE than this overall market, which is pretty pricey? Well, the reason for that is there is litigation risk, and I want to discuss that today because litigation is a theme that's very important for dividend investors, long-term investors, individual stock investors to understand. The current dividend per quarter, the increased rate is $1.13 per quarter or $4.52 per year. That places the starting dividend yield right now around 2.5%. Again, that's nothing super exciting, but the fact that the payout ratio is 43%, 43.8 shows that there's room to increase it. So that's why I highlight that number as well. And the fact of the matter is, on average, each year they increase it by 6.1%. And so starting yield doesn't have to be huge as long as it just keeps increasing over time. And I add fuel to that dividend snowball by reinvesting my Johnson & Johnson dividends as well. This is a big company with a $481 billion market cap. It's really important to understand that because they have a lot of legal risk that they need to shoulder, but this is a big company, so they can possibly shoulder that risk. And so with that, I have another piece of news that I want to share on the screen with all of you. And you may have heard over the last few years, there has been a lot of talk about the opioid epidemic, unfortunately, and potentially Johnson & Johnson and other big pharma's role in that epidemic. Long story short, the states in the United States have been going after the healthcare companies and saying that they are partially at least to blame for the opioid epidemic. And so Johnson & Johnson and other companies have been settling with these states, but they also have a national settlement as well that kind of groups a lot of the states together. But some states opted out of that, and so they're settling one by one with Johnson & Johnson. Now, the reason I'm bringing this up, no one's talking about it. We all knew there was a lot of risk with this company, with this opioid epidemic. Now, before I go any further, my heart goes out to anyone affected by opioids, whether it's themselves or family or friends. My heart goes out to anyone affected by the epidemic. Here, I'm not meaning to be insensitive to the epidemic, but I'm more just looking from a business standpoint, how does this affect Johnson & Johnson? And so what I want to do is just share on the screen in front of you right now. I've been seeing these news releases kind of on the regular lately, and no one talks about it really. No one's been talking about it. That's why I want to talk about it. This one says Johnson & Johnson enters a $99 million opioid settlement. And this is, it's Janssen Pharmaceutical subsidiary at Johnson & Johnson. This was the state of West Virginia. And so this is just an example of the type of news I've been seeing, and it's been coming out really regularly. I've been seeing news like this. It kind of comes in, but this week has been a big week. There's been a few of them that I've noticed, but again, no one's talking about it. Now, the backdrop here is there was a national settlement, and again, some of the states opted out of that, but this national settlement was big. It was like a $20 billion settlement, but the $20 billion, of that $20 billion, Johnson & Johnson is shouldering 5 of that. The rest is coming from other players in the industry. My understanding is this settlement agreement is actually the largest other than the master settlement agreement that affected all the SIN stocks that I own as well. That one happened a long time ago. Anyway, I want to share my spreadsheet again. As you can see in front of you on the screen right now, let's get an idea, like what does this mean for the company? Well, what I did is I just do a timeline, and you can see the settlements, and this is in millions of dollars. And you can see they settled with basically Oklahoma, That was 572 million. New York, 263. The nationwide for all the states that kind of band together was 5 billion. West Virginia, 99 million. Alabama, 70.3. As it pertains to opioids, so far, Johnson & Johnson is shouldering about $6 billion of settlement risk. That seems to be what's happening right now. Now, my understanding with these settlements is the money's going to go to the states, to the government, and the government's supposed to use this money for education, healthcare services, and to help people affected by the epidemic. Now, I really hope that the money doesn't get lost in the bureaucracy and it actually goes to doing good. Time will tell. We all have our own opinions on that matter. Now, the reason, though, I'm highlighting $6 billion here is I want to understand this is why the stock was down and it was lingering for so long, kind of as a laggard. Now it's up. I bought last at 178. I'm going to be buying more of this next week on Monday, most likely. It's trading around 180 now or so dollars. Why is it doing really well, even despite the market going down? I think it's because there's now some certainty to the situation. Before, we didn't know what this settlement agreement would look like. For all we knew, it could have been bigger than the master settlement agreement with those sin stocks from all those years ago. And if that were the case, it would be really bad. But at a $6 billion level for J&J, and say that gets up to like $8 billion if there's more states come through, in general, I don't like it. I'm not an expert on the matter, but as a shareholder in a company, I don't like seeing a company having to pay out that kind of money. But what I want to do is I want to share their balance sheet, and I want to just go through it quickly. This is from their last annual report, so it's a little outdated. But as you can see on the screen right now in front of you, this is really important to understand. So let's look really quickly at the Johnson & Johnson balance sheet. Now, what you can see in there is cash and cash equivalents. They have about 14.4 billion. And so what I'm saying is they could pay this settlement just out of cash on hand. Marketable securities, 17 billion. That's liquid. Again, they could pay it right out of that. So just in current assets alone, they're pretty good. You can see that current assets are bigger than current liabilities, which is lower on the page. The total current liabilities is 45 billion. And so again, the delta between the current assets and current liabilities is enough alone to shoulder and to pay for that. And so that's good to know as a shareholder. One other thing I want to show you on this screen is the long-term debt is only, it's still a lot, but it's almost about 30 billion. But 30 billion in the scheme of things for a company that has a market capitalization of almost 500 billion is not too bad. They're managing their debt pretty well. There is a positive shareholders' equity of 74 billion. This is a really solid balance sheet that I'm showing you all right now. And the reason I'm showing you that is twofold. One, I think the reason the stock is going up and will continue to go up, and I think the PE ratio here is going to probably get up a bit higher towards that 20 PE range if I had to guess, or if the whole market just tanks, I think maybe it'll stay where it is. But I think J&J is going to outperform the market here because I think a lot of this uncertainty is gone, and I think they can shoulder the risk of the opioid epidemic. What I would say as well, though, is Starbucks. Starbucks stock is down. My patrons know I bought a lot of Starbucks stock this week, a lot. My position is way bigger, way bigger, orders of magnitude bigger than it's ever been. It's finally right-sized to where I want it in the portfolio. There's a lot of uncertainty around Starbucks right now. I don't need to talk about Starbucks too much today, but I like to invest in world-class companies where there's enough uncertainty that puts them under pressure, but there's a pretty good probability that they get through the uncertainty and they have some kind of resolution that's at least somewhat favorable. And that's what happened with the opioid crisis at Johnson & Johnson. And I expect that Howard Schultz is going to right the ship at Starbucks. It may take a year, it may take 2 years, but I'm happy to be buying in the low 80s, high 70s. If it dips lower, maybe I'll add a little more, but to be honest, I bought enough Starbucks now. It's big in the portfolio, and so I'll just reinvest dividends from here on out, but maybe I'll pick up a little more. I can't help myself. Anyway, I want to keep going. I have some more to share on Johnson & Johnson. Check it out on the screen in front of you right now. Though although the opioid uncertainty is removed, one of the reasons the stock is probably lower than it would otherwise be is there's still talc powder risk. As many of you are aware, there is a talc powder series of lawsuits against Johnson & Johnson. Well, there was like some tens of thousands of lawsuits against them as it pertains to the cosmetic talc powder. Now, worth noting, I don't know who's right, who's wrong here. J&J is claiming that there's nothing wrong and that they've done rigorous testing on their talc powder, and they've also done rigorous analysis of their marketing of opioids. They're saying they did nothing wrong. And so I'll let the courts decide who's right, who's wrong. Let's trust the science. They're going to test all this talc powder. But nonetheless, there are people that believe they were wronged by J&J on talc powder. Well, they actually had a pretty good resolution on the cosmetic side of that lawsuit. What happened is they were able to create a new entity, a spin-off kind of entity in Texas. They were able to put all of the talc powder kind of related liability in that entity. And now that entity is basically being bankrupted. And so they were able to mitigate risk, lawsuit risk that way. Now, the challenge, though, is it's not just the cosmetic risk. There's a new class action lawsuit. No, I don't know if it's new, but there's a class action lawsuit now from Johnson & Johnson employees that was kind of more on the industrial side of things, that's saying, hey, we worked in the mine that mined the talc powder, and we believe we were exposed to asbestos. And so because that lawsuit is materially different enough from the other lawsuits, the cosmetic ones, the judge was actually saying, sorry, J&J, you can't put that one in your Texas bankrupted company. That one will have to go to court. And so that one will have to go through the process. It will have to, it won't have the bankruptcy protection of the other one. Now, I know J&J, and many of you do, is splitting into two companies. They're going to have the pharma company and the kind of cosmetics, consumer products company. I think that mitigates some of the risk, but there still is risk. And the main risk that's left is not the opioid risk. It's not the cosmetic risk from talc powder. It's the talc powder industrial risk, class action from the employees that claim they were wronged. Now, again, I don't know if they're wronged or not. We'll let the court decide that. But the reason I'm going through all of this is it shows you the evolution of how I analyze risk. And what I'm trying to say is we see how it's going with J&J. Thank goodness it's a strong enough company that it can shoulder this. But here's some thoughts that are going through my mind these days. Not all companies are strong enough to shoulder this kind of thing. There's a lot more risk in our modern society where people are organizing via social media. They're unionizing. They're class action organizing. They're going after companies. Big companies, the types of companies I invest in, are becoming the target. They're becoming the target of politicians. They're becoming the target of just people who think that they have too much money, the company has too much money, and they deserve some of it. There is a new mentality and way of thinking that is permeating society these days that puts individual company investing at risk. And so first and foremost, as a dividend investor, I like to diversify. I own over 50 positions, and I want to diversify. Even though I love Starbucks, I love J&J, I have to be careful not to make them too big in the portfolio. I'd say the biggest I want a position to be at this time is about 10%, because the way I look at it is if a 10% position faces a terrible, terrible problem and say it gets cut in half, the overall portfolio only loses 5% of its value. That's how I'm kind of looking at it only. It's still a lot, but I can shoulder that. But what I'm saying is I think it's more important to be diversified than ever before. One other nuance to this point is we all thought all along that sin stocks, they're so risky. Sin stocks actually may be less risky than a lot of these other companies right now because they already settled. The settlement happened a long time ago, early 2000s. It was during a different time, too, when the politicians and the people weren't so aggressive against companies. So they got that settlement. It's done with. I don't think that can be reopened. And so what I'm saying is food for thought, contrarian idea here. Maybe those sin stocks are less risky than all of these other companies that haven't reached settlements yet or have more exposure. And so something to think about. With all of that, if you enjoy the video so far, please go ahead and smash the like button. It means the world to me. It helps me with all I'm doing here on YouTube. Also, please don't forget to subscribe. It means a lot. It's difficult to do all these videos in real time because we have a lot going on right now. But things are moving in the right direction. With that, I want to share some more screenshots. Check it out on the screen right now. And so the next one that I want to share with all of you today is just some information from the Johnson & Johnson earnings report. They recently reported earnings, so let's see how's the company doing. Well, the first thing I want to look at is overall financial results. The sales are up 5% year over year, not bad. EPS diluted are down, but that is because of amortization, to my understanding, and mergers, acquisitions. And so if we look at the adjusted EPS, it's up 3.1%. And so not bad, not stellar growth, but slow, steady wins the race. That's all I need. I don't need hyper growth. I just need moderate growth, but I need to stick with that for long periods of time. By the way, I'm deploying some money in the market right now. I've shared this with my patrons on Patreon. It makes me a little nervous because these are some bigger trades. Market's been volatile. I'm already down on paper on some of my purchases. I want to just share that with all of you, that even someone who's been doing this for well over 20 years, I feel it. I feel the market volatility, and that's why I have to follow the best practices of dollar cost averaging, focusing on income, focusing on quality, diversifying, not looking at the numbers day to day, except when I'm buying, and take my time. I don't need to average all the money in right away. I can spread it across time. And a downward market is good because each tranche will progressively be at better prices, but it's better to average than just to place it all in on day one. Now, by contrast, averaging into an upward market, at least even though I would be getting higher prices each time, I have the peace of mind that I wasn't taking on undue risk. The other thing I would say is, as I dollar cost average into different positions right now, I try to place an emphasis on the ones that I feel that are on sale right now. So for example, Starbucks and 3M were actually on my list pretty heavy this week. 3M is another one that has litigation risk, enough uncertainty to place a thing at a forward PE of I think 13 or something now, which is crazy for 3M. I'm willing to take on that calculated risk. Let's look at another screenshot. Check it out on the screen right now. The next one I want to share with all of you is the regional sales results. You can see this is a multinational company, and in the US, they're growing just fine. Adjusted operational, 2.8%. But what I love to see is they're really growing international and worldwide. This is an international company, and they are growing internationally. I love seeing that out of the US growth. That brings diversification by region to my portfolio. And segment sales results, you can see consumer health is a little slower. They're spinning it off. It also has some risk with that talc powder. Pharmaceutical, medtech, though, are both growing really fast. Really fast. 9.3%, 8.6%. And so the point there is they're doing the right thing, kind of spinning off that slower growth division. It not only mitigates risk, but it's slower growing, so that the faster growing divisions, maybe they'll get a better PE premium. They'll unlock some shareholder value. I'm going the route I did with United Technologies before the Raytheon Technology Otis Carrier spinoff thing, and I'm accumulating aggressively in J&J right now, even though there is risk, and there's a lot of risk. Who knows what comes with this talc powder industrial class action? We shall see, but it's more important as a dividend investor in 2022. We know the world is different, to be diversified. This ain't 2010 anymore. This isn't 2000. This is the world where social media has linked together a lot of people, and they're mobilizing. I was reading something about Bernie Sanders, a very popular politician here in the United States. I know I've got so many international viewers here. I love you all. That's my favorite thing about the channel. So I want to provide a little U.S. perspective if you're not from here. But he's, to my understanding, based on some of the articles I'm reading, he's actually pro-union, and he's trying to go out and kind of encourage unionization at various companies. And so that's just a kind of a political nuance that I thought I would never see. If you asked me about that when I was investing in 2010, I'd be like, what? No way. You know, it's just a new reality of 2022. So what do? I diversify. And I actually am looking more than ever just at other ways to diversify, other asset classes, even different vehicles like mutual funds, retirement accounts, so on and so forth. All right, everyone, I love you all. If you enjoyed the video today, please go ahead and smash the like button. It means the world to me. This is dividend investing for everyone. No matter where you live, no matter who you are, in my opinion, dividends provide value and an opportunity for the average person to really take on their finances and to automate income, which is more important than ever before in 2022, in my humble opinion. And if you enjoyed the video, please don't forget to subscribe. It means the world to me. All right, everyone, before I go, in terms of a full disclosure, I'm long the stocks mentioned today. I'm long Johnson & Johnson, ticker J&J, Otis, ticker OTIS, Carrier, ticker CARR, United Technologies, ticker UTX, StarBucks, ticker SBUX, and 3M, ticker MMM. Please put in the comments below what you think about these stocks and what you think about the stock market. Are we in for a big collapse? We shall see. Dividend investors sometimes like that because they can buy stocks at lower prices. I know I plan to be shopping. Before I go today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed investment advisor first. It's possible to lose a lot of money in the stock market, so please consult your expert financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. All right, everyone. I'll see you over on Patreon. I'll see you in the comments below, and I'll see you in the next video.